Good evening. Welcome to the earnings review, your tidbits into company financials and operational insights. Thank you for joining us as we broadcast from Hampton Studios in Harare, Zimbabwe. I'm Ibn Mabunda, yo money man. On the show, we engage top echelon executives to get you up to speed with first-hand information. We also chat with the most competent analysts on the market to ensure you are furnished with relevant as well as competent analysis. Tonight, we focus on Fidelity Life Assurance, a listed financial services group on the Zimbabwe Stock Exchange. Now, just a quick take into their timeline. Incorporated in the United Kingdom in 1936 as the Legal and General Private Limited, the entity went on in 1936, a century later, to open a subsidiary in Bulawayo. In 1988, that subsidiary was disposed to a local consortium, which then rebranded the entity into what is known as Fidelity Life Assurance. A key development taking place in 2003 as the firm went on to list on the Zimbabwe Stock Exchange. 2005, the firm became the very first in Zimbabwe, in as far as insurance companies are concerned, to receive an ISO certification. But then, just who is Fidelity Life Assurance? The entity offers a wide range of services ranging from life as well as funeral assurance, employee benefits as well as medical insurance. Some of its key units include the Fidelity Life Assurance unit here in Zimbabwe, Vanguard Life Assurance in Malawi, as well as the Langford Estates here as well in Zimbabwe. The group is also invested in actuarial services as well as residential property development. In the region, Fidelity Life has continued to make inroads, hunting and seeking for opportunities, as evidenced by a presence in Malawi as well as Zambia. FLA also has subsidiaries in related financial services, including asset management services as well as financial services. On to some quick stats. With a market capitalization of over 2.1 billion Zimbabwean dollars, its share price is currently trading as just below 20 cents, having soared by over 113% since the year began. Of note is the fact that the financials index has also moved 250% over the same period, over which the Zimbabwe Stock Exchange All Share Index has soared by over 300%. Now, some key developments where the firm is concerned: Fidelity rolled out Zimbabwe's first funeral cashback plan in May of 2019, offering its clients cash back for up to 5 years. FLA has also made significant advances in as far as what they call the Digital Transformation Initiative. Some of the vital developments that have taken place there include what they call the FLA application, where they get to offer services to their clients in as far as insurance is concerned on that very digital platform. In partnership with a UK-based firm, FLA also went on to launch what they call the Flima's Afia PAP application, whereon they get to offer, through artificial intelligence, medical assistance to hypertension as well as diabetes patients. And of course, Fidelity Life is also responsible for the South View project in southern Harare, which of course was launched in 2015 with over 5,300 stands. Over 5,000 stands have been developed and sold, with just some off-site development taking place there. This of course would conclude the Halaju section of our show, and in just a moment we will be crossing over to an earlier conversation we had with the Group Chief Executive, Mr. Ruben Java. Don't go anywhere. Good day, Mr. Java, and thank you for joining us on the earnings review.
Thank you very much, Ibn, for having me.
just to take a sneak peek into your 2019 performance and a little bit into your most recent trading update. Of course, you rebounded into a profit position in both historical as well as inflation adjusted terms. Can you give us a brief comment where that particular performance is concerned and perhaps shed light into some of the highlights that were the key drivers of such a performance?
So thank you very much, Eben. As a business, we are cautious but satisfied that we were able to deliver a modest profit to the shareholders, and even more satisfied that that profit is above inflation, because we made a profit on an inflation-adjusted basis, and therefore that we've got a profit which is above inflation means that we were able to protect value for our shareholders. That's why we're satisfied that we were able to do that. And this coming in a year where most financial institutions actually delivered losses to the shareholders, and then, which is the norm in a hyperinflation environment. You expect that on an inflation-adjusted basis, most businesses will make losses, but we were able to make an inflation-adjusted profit, but it's not an accident. It's a function of the strategy that we are pursuing. And so, but just some background to this. I joined this organization in October 2017. So in that last quarter of 2017, when I joined, I was given a mandate by the board, which had just been put in place in 2016. And the mandate was to implement some of the key recommendations that came out of a forensic audit that had carried out on the organization, and to do so in conjunction with guidance from the regulator. So that was the mandate that I was given, to make sure that we deal with the past indiscretions, put in place a sound governance framework, and then set up the business for sound and sustainable financial growth going into the future. So in the quarter four of 2017, we developed a strategy which essentially had just three key pillars. And as you would have guessed, the first one is sound corporate governance, then brand repositioning, and financial growth. And what informed these pillars was, well, first of all, because of the past indiscretions in the organization, it was important to make sure that we build or put together a sound governance framework, which is always important. So when you look at the business that we do, the benefit, it's essentially about promising benefits which are to be paid well into the future. Now, the value of a promise like that is anchored on the governance framework that you have in place. And so that's why it was important for us to make sure that we institutionalize a sound governance framework. It is what reassures customers that whenever that benefit is due way into the future, we'll be able to deliver on that promise. That promise is anchored on the basis of a sound and institutionalized governance framework. So that's the first pillar. And the second one is, of course, brand repositioning. So our brand had been tainted due to those past indiscretions. So, of course, we had to go through the brand repositioning exercise, re-engaging with the market, and then going through the relevant brand campaigns to make sure that we put the brand back up to where it's supposed to be. And then naturally the third pillar is financial growth. And so those are the three key pillars we developed. I'm happy that, so in the first 2 years, so 2017 and 2018, we actually made losses. But those losses were the school fees that we had to pay as part of rebuilding our business and rebuilding that governance framework, and therefore to deal with those past indiscretions. So we made losses in 2017, 2018, but that was the cost of putting in place a sound governance framework and dealing with those fasting.
In a nutshell, you're saying what we are seeing now is the results of the sound corporate governance that you have implemented and have put in place to push the vehicle forward.
So it was. I think generally, if you've got a business that's not in a very, very healthy situation, the first one to do is to go in and understand what it is that has gone wrong and to repair that, then set it up for growth. So that's the first thing we did. But most of 2018, that's what we were doing. Then into 2019, we started implementing the growth strategy. And our growth strategy was, it had a number of key factors that we were, or key strategic initiatives. The first one was that we made a decision to go back to our core insurance competencies. And that's because we have built these assets that we have based on the revenue that was generated from the core insurance competence that we had. So we made a decision to focus on our core insurance competencies. And the second thing we did was, of course, we because knowing that we were going into, because high inflation started in 2019, knowing that we were going into hyperinflation, it was a conscious decision, which any clever asset manager would need to do, to focus on asset preservation. And this was always informed by some of the lessons that we learned from the 2008 hyperinflation. And some of those key lessons, what they taught us were, if you are going towards hyperinflation, you need to move most of your assets into real assets. And in terms of order of priority, to the extent that it is practical and legal. Right at the top, if you're able to hold a foreign currency, like United States dollars, that would be a pretty good investment. Then the second one, of course, was property. And then the third one would be equities on the stock market. And we would only hold money market instruments for liquidity requirements. So that's something that we did a lot of that in most of our cash and anything that we collected, net investable funds were being moved into real assets. So at the end of 2019, if you look at our balance sheet, we're sitting at between 70 and 85% in real assets. A huge proportion of that being property, and then significant proportion being equity. Very little. So when you look at our balance sheet, you may find 7 to 14% in money market instruments. Within some of those instruments are investments that are done in Malawi for our life assurance unit in Malawi. In Malawi, if you know the Malawi market, some of the key investments for them are actually bonds and money market instruments. Unlike here, where there's a whole lot more property and equities, the Malawi Stock Exchange has got 13 counters. So there, bonds and the money market instruments are actually good investments from an investment perspective.
Now that you, Ruben, now that you just brought onto the table your operations in Malawi, contribution to revenue came in at 38%, a 200% surge from the 12% reported in 2018. How strategic is that vehicle in terms of forex generation, and what are the medium-term plans where that is concerned, and perhaps also tapping into the regional markets?
I think that when you look at the contribution of VLA in 2018 and then 2019, I think that when you look at the numbers that you are communicating, I think we are comparing historical performance and inflation-adjusted performance. If you are comparing inflation-adjusted 2018, 2019, the growth was actually from 22% to 38%. And of course, we would have wanted a whole lot more. And then, no, that's all right. We would have wanted a whole lot more. And the reason why we need a whole lot more coming from that asset is because it is a foreign asset. so the picture that I see when I look at insurance businesses is this. Zimbabwe is in the throes of hyperinflation. We will have a strategy to protect revenue streams in Zimbabwe and to protect the assets in Zimbabwe through various asset preservation activities. But because of the hyperinflation, there is still going to be impact on revenue. And to balance that out, we need our foreign assets to perform, to do more, to contribute even more. So, as you can imagine, we're paying a whole lot more attention to Vanguard Life in Malawi. And so we have a number of initiatives, or a number of areas that we are looking at in terms of Vanguard itself, but without precluding ourselves from any other opportunities that may happen anywhere in the region. And then, so the reason is, we like anything that is in the region, because to us, it represents country diversification, so de-risking from Zimbabwe's hyperinflation, but also it represents what is a real asset, so that when you convert it when you're doing the financials for Zimbabwe, when you convert it, its contribution is very significant. So we're paying close attention to Vanguard Life Assurance, and we're looking at any opportunities that may arise in the region. We would like to get involved in them, because that is any foreign asset for us will help to dampen the negative impact of hyperinflation in Zimbabwe. So that's how we are looking at Vanguard Life Assurance and any other opportunities in the region. I don't know. I can touch briefly in terms of the things that we are looking at in terms of Vanguard to sweat profit out of it. So we're looking at probably 3-4 things. The first one is we have done a review of the product mix already in Q1 with a view to focusing on capital light products as a way to protect our capital. And of course, the second thing is we're looking at new markets, areas that our business may not have exposed itself to. So here, we're looking at new markets that make business sense. So markets that make business sense are the ones which have got large databases. So mobile network operators or any banks, those would constitute attractive new markets. So that's the second thing. So new markets, and then of course we're looking at products that may appeal to those kinds of markets, and then the fourth thing, of course, be choice of access channels, because when you look at different markets, you probably need to use different channels which appeal to those particular markets. So those are things that we are looking at in terms of Vanguard Life. The other thing that we have done at the very beginning of the year is to add to the technical bandwidth in Malawi by seconding an actuarial resource there to try and support the business because if you're going to do a product review, new product development, channel development, and the other technical aspects that relate to the business, you need enough technical competence. So we've seconded an actuarial resource there to help the business. The intention is to sweat more profit out of Malawi.
Fair enough. Now
so that's what we are doing in Malawi.
Back to operations here in Zimbabwe. Given the market vagaries that we see playing out in Zimbabwe, particularly the high levels of inflation, as well as, of course, the volatility where interest rates are concerned, how are you mitigating against risk in as far as the Fidelity Life financial services are concerned? And perhaps also you would also want to shed light in terms of how you are navigating the waters as well from your flagship brand, which is the Fidelity Life Assurance unit.
Okay, good. So thanks for that question, Ivan. So like all other financial services, we are faced with hyperinflation, and as we said in our financials, we pointed out the fact that the revenue is negatively impacted. It's a function of salaries, and salary inflation is below price inflation. So that's bound to come off. So we've seen a reduction in our revenue, a reduction of about 35%. And that's a concern for us. So to some extent, the foreign businesses will try and immunize that particular decline. But within this country, there are certain activities that we must engage in to try and protect the revenue stream, protect the assets that we have in this country. But so in terms of the local market, what we are clear about is business that's written, or if you do business in the right currency, so foreign currency, that will protect you, or that will protect your revenue stream from high inflation. And business done in purely Zimbabwe dollars, RTGS, will be at the mercy of hyperinflation. And so what we have done within the life assurance business is firstly to look at our markets more closely, to segment them into those clients who are actually doing business as allowed for by the government of Zimbabwe in US dollars. Then the second segment will be something which is a proxy of US dollars. So there are businesses that are operating in that generate revenue, which is indexed to the US dollar. And then, so they also are to some extent protected from hyperinflation. Then the third segment of clients or market are those who generate purely RTGS. Now, when you've segmented your market like that, it's to have a look and review your product offering. So different products will appeal to different segments. And then again, as we are doing in Malawi, you would have to define or set up your channels in a manner that can speak to the segmentation you've done. And then, but the more important point is the choice of priorities and the investment that you do in order to go into a specific segment is a function of the value that you expect to get out of that particular segment. And so that's a key and sensitive thing. We have to provide services to all three segments, but we need to be careful about the investment that we put into generating value in each segment. So that's one of the things that we have done. So you will find that our own distribution channels, if you're looking at the businesses that do corporate business, deliberately approach customers knowing that the markets can be segmented as we have done. And therefore, so that helps us. The focus is now driven by what you are looking to achieve, which is protection of the revenue stream itself. So that's what we're doing in terms of the revenue. It's segmenting the markets, defining the investment of chasing value in each market to make sure that the value is consistent with the investment that you put in. Then, of course, the second thing is we have built assets over the years, and those assets need to be preserved. And so in terms of preservation, I've already spoken about that we have defined the order of priority when we're looking at investment classes. So we have directed our assets, we have invested our assets in line with that investment strategy, that choice of priorities in terms of asset classes. So that's the other thing that we have yet to do. And then, of course, accepting the fact that we are faced with hyperinflation, so we have had to look at more work in the region, which we have already spoken about. But essentially, this is what we are doing in Zimbabwe for the life assurance.
Talking about Zimbabwe, there is a growing demand, particularly where your sector is concerned, for cover in other currencies. How are you responding to that?
We have laws and regulations in the country. So whatever products we develop need to be consistent with the regulations and what is allowed by the authorities in the country. to the extent we are allowed to develop contracts in foreign currency, that is absolutely fantastic. Their clients were allowed to operate, generate, and pay employees in US dollars. And to the extent that we are allowed to collect and get into contracts in US dollars, we have developed products like that. I'm not sure if you're aware, I think the first 29 Solar, we actually developed a cashback funeral product, which was purely in US dollars. And so that was directed at clients who earn that particular currency. And at some point also, we were able to sell products, whether it's group life assurance or products that are targeted at corporate clients. We were able to sell some of those products in foreign currency, but somewhere along the way, the regulations made that illegal. But we continue to engage with the regulators to make sure that for those clients who are already earning free funds, we are able to sell them products that speak to the currency that they earn. And I mean, recently you would have seen that the government itself has allowed for transactions for anybody who is earning free funds for us to be able to do business in that currency, in the currency of the individual, because it's allowed to trade in free funds.
Quite comprehensive.
But I think what's important is we cannot take the same products that we are selling in Zim dollars without any review. So we have had to look at some of these products to make sure that they speak to the specific peculiarities or things that are important to this particular market who are generating forex.
Fair enough. Langford Estates, they're boosting your solvency by a good 177%. What is the plan for that very asset?
So I think you're right. Langford Estates did help to get our solvency that high. So we're happy that we've got a solvency margin which is sitting at 177%. You will have noticed that in the past, our solvency position wasn't always satisfactory, and we attribute that to artificially low asset valuation in the organization, and it stemmed from the way we were treating our investments in the various subsidiaries. And so in 2019, we started a piece of work which we went through the whole governance framework, which are our own board of directors. And then also we engaged with our external auditors to make sure that we're doing things correctly. So we did a number of balance sheet restructuring initiatives. And of course, one of them was to make sure that we reflect all subsidiaries at values that reflect the value of those businesses to us in current terms. Because in the past, we were reflecting them at historic cost. So the price that we paid for a subsidiary, that's what we recorded as the value of that particular subsidiary. And you would admit that with inflation, you cannot say a value that you bought an asset 3, 4, 5 years ago is what you put in your financials and call that the value of that particular asset. So we've had to go through an extensive exercise to look at how we treat our subsidiaries. And what it has done is to unlock value, which is what has led to the change in value of the assets and improvement in solvency. So the point I'm making is there is an exercise which looked across all the subsidiaries, including Langford Estates. It is that which has surfaced and reviewed what was essentially hidden value in the organization But of course, Langford is one of the
just
key
to
ones.
stop you in your tracks. Very quickly,
Yes, sir.
how prepared are you to deal with the lawsuit that CFI is throwing against that very asset, in a nutshell?
My initial view is, I think, or my considered view is, it is not the right time to have a conversation around the court process, because as you rightly point out, the matter is below the courts. CFI sued Fidelity Life, and the matter is before the courts. We feel that having a conversation about the matter before the courts is not the right way to engage on the matter. We are comfortable with the position that we hold in terms of this particular asset, but we are comfortable and confident in respect of the position that we hold for this particular asset. But I think the fairest thing to do is to let the courts go through the process, and then we can have a grander conversation about the asset itself.
Fair enough. Now let's talk about the impact of the COVID. A significant portion of the workforce.
Sir, could I cover something on Langford? There's something you said.
Sure.
What are our plans around Langford? So I can speak around Langford, the plans, but what I am cautious about is not to have a conversation about the court case itself. Safe to say, to put on the table what is in the public domain, that you have been sued, we are defending that position, and we're pretty confident about it. But in terms of the asset itself, so in the short term, we are looking at it as land held with capital appreciation. And it's a real asset. It provides inflation protection, and therefore, to some level, it meets the inflation protection expectations of investors, of our shareholders and our policyholders, who are the key investors in that particular asset. So it is a good asset, good match for those for some of our liabilities. So in the short term, we are holding it as land for its capital appreciation. But this is well informed. There's always a temptation which says, well, shouldn't we be developing it to add more value and surface even greater value for shareholders and policyholders? But if you look at a valuation report from any property valuers, you'll see three values. One is the fair value, which is market value. Then one is post-sale value. And then the third one is replacement value, replacement cost. In most of those valuations, the replacement cost is the highest number you ever see on that particular page. And the reason for that is to reflect the fact that for you to replace that particular asset, in a sense, the cost that you must incur to develop a property is at its heaviest at this point in time. So we will look at what other value addition activities, initiatives that we may do on Langford on a longer term basis as opposed to very short term basis. Very short term basis, we hold it as land for its capital appreciation. We are not looking at developing Langford in an environment like this because the cost is extremely destructive to value in the organization.
Now, let's talk about the impact of COVID-19 on business, not just where Fidelity is concerned, but looking at the broader spectrum. A significant portion of the workforce possibly faces retrenchment because of how COVID-19 has affected normalcy of business. And that, of course, could affect your revenue generation as well as insurance payouts. What sort of strategy do you have to mitigate the risk associated with that very development, that possibilities, should I say?
So thanks, Evan. One of the things that confuses the picture in Zimbabwe is that we've got two there were two challenges, two problems that are facing the country. One of them is hyperinflation, which we were deep in, and then COVID-19 came onto the scene. So it probably confuses or compounds to the strategy to deal with the impact of hyperinflation on revenue, because we've spoken about that earlier. So, but in terms of COVID-19 itself, the way I look at it is, well, it is it is a virus that's affecting the whole world, and it has driven the whole world into a recession. So across all countries, including Zimbabwe, it is expected that productivity will be down. And therefore, we also expect that there will be an impact on the revenue that we collect, and because of that particular outcome. But our view is to do the best that we can within that situation, which is difficult. And the way we have looked at this, and so we did this at the onset of COVID-19 itself and way into the lockdown. So we sat down with our team, our executive team, and then one of the key things that came out of it was, so we understood that this impact is coming to this country and to all countries and into this country. So what we did was to sit down and say, because any negative impact in an economy will affect different sectors differently. So what we did was to sit down and understand, look at the economic sectors in the country, and look at even some of the big businesses, some of the businesses in those sectors in the country. And then again, we did a segmentation to say, which are the clients that are likely to be less affected? And then we created segments. So those who are likely to be less affected will be right at the top, those with medium, where the impact is medium, and then those worst affected at the bottom. And so when you have defined your market segments like that, your effort in terms of channel deployment is a function of what you are seeing. And therefore, the investment that you put into chasing value in each of these segments is a function of the value that you expect to get out of those segments. I think at a very high level, that is one of the things that we did. So we listed the sectors themselves and even picked individual corporate potential clients in there. And therefore, our focus will be to target value at a cost that makes sense for the value that we expect to generate from each of those segments. And naturally, if we have to review the products offering in order to speak to the most resilient markets, then that's something that we are doing too. So that's in terms of trying to protect the revenue. That's one of the things that we have yet to do. The other thing is also, even as there are certain products that don't cost much. And so and most risk products do not cost a lot of money. Savings is actually a difficult sell in hyperinflation. But most of the products, or some of the key products that we put out to the market, which are risk products, the products that cover life, that provide a benefit on the passing on of an individual, of a breadwinner, they do not cost a lot of money. I think what's needed is the right sort of engagement, the right language, so that customers can understand that there is still value in terms of certain of these products. So it's choice of the products, but also segmentation allows you to target the different sectors with the right sort of products. The other conversations, which I think we spoke about it earlier, that we've been engaging, so with the regulator on is, so some of the most resilient segments are those segments which are generating foreign currency. In my mind, they are likely to be less impacted. And for as long as we're able to deliver products to them that speak to what their needs are, that are affordable to them, using the right channels, there will always be value that can be generated from those particular markets. So those are some of the initiatives in order to protect revenue. But that's within Zimbabwe. If you take into account the twin impact, which is hyperinflation, absolutely the regional business we have and any other explorations into the region become fundamental. And then we think that, again, the impact of COVID-19 is different between countries. So if you have businesses that are spread across different countries, the impact is likely to be less than if you are sitting in the one country. So there are initiatives that we will implement within the country, and then, but also we need to pay attention to our businesses that are outside Zimbabwe, because they are likely to be affected perhaps differently from Zimbabwe, and the value that we get from there, aside from the fact that it's foreign currency, the impact could be different. So that's what we are doing in order to protect the revenue. So of course, then in terms of the claims, we think that the impact, so it will differ across some of the subsidiaries that we look after. We think that in terms of the medical aid business, there might be a bit more impact in that space in terms of claims, but we don't shy away from paying valid claims, because that's the business that we do. For as long as we got, and in any case, as an organization that's responsible, we always carry the right sort of reserves. So if you go to the life assurance business, my perception is, in terms of the core benefits, which are the risk benefits, I don't see. I mean, we've seen the number of people passing on in Zimbabwe. We don't think that's a large enough number to cause devastation into anyone's financial. So we think that from a life assurance perspective, I think the claims are manageable, and then the impact, for example, if we do provide cover when people are retrenched, which is likely to happen because of the economic recession, our role will be to make sure that those benefits, which are largely withdrawal benefits of whatever savings they've built up, are paid out. It's what we do. Our role, because we already have the reserves for this, is to make sure that we've got adequate liquidity in order to meet those particular benefits as and when it happens. At the start of well before the lockdowns themselves started, we had developed a strategy. We had developed a digitalization strategy. And so we did this in 2018, and we made a whole lot more progress in 2019. Now, what you will have noticed with the advent of COVID-19 and during the lockdown is what was imperative was that, because of the various guidance which were given by World Health Organization and this government of Zimbabwe itself, what was key for any business was to make sure that you could engage with your customers across the whole value chain remotely. So as luck was, well, I don't know if it's luck, would have it, we had already started on the journey of digitalization, which was to digitalize our processes across the whole value chain. So from a sales and distribution, revenue collection, client servicing, and claims payment, we had made some progress, but the lockdown actually surfaced perhaps some of those areas that needed more development, like sales and distribution, how to engage in sales and distribution engagement on a remote basis, essentially what we are doing now. So some of those one of the things that has come out of this lockdown is the need to accelerate our digitalization project, our digitalization journey, to make sure that everything is digitalized across the value chain. But the important thing is we had started on this journey, and the fact that we had started early held us in good stead during the lockdown itself. We were able to engage with our customers in terms of any payments that they needed to make into us, and any payments that we needed to make to them, and any queries that they may have had with us. We were able to do so because we started our digital journey early in 2019. And by the time COVID came around, we were, if you think about it, it was a pretty good dry run for what we had already implemented. Responses to COVID-19. So we've spoken about the kind of work and initiatives that we have put in place to make sure that we protect the revenue, the kind of activities that we would need to engage in to make sure that we pay claims when they are due. And then, so the third thing is, if your revenue is impacted as a business, you can do the best that you can to protect the revenue. But one of the things that you must do as responsible leadership is to go down to the cost structures and to look at what else you can do to make sure that you contain the cost structures. Because at the end of it, what we're trying to do is protect value and protect profitability of business. So we do the best that we can in terms of revenue protection. We must do more. We must also look at the cost structures. So in this space here, so that conversation about digitalization comes in handy again, because what digitalization does is it creates a cost-effective value chain and therefore contains costs and helps to protect profitability of a business. Then, of course, I mean, a sensitive area would always be the fine balance that needs to be maintained in containing staff costs, but also ensuring that staff are looked after. And more importantly, one of the things that business must always be careful about is, in a situation like this, it's important to protect top talent, the key skills that you have, because these are the people that will help the business into the future. And that way, we keep making the business future fit. That's how I would look at the picture that we are as a business.
Welcome back, viewers. Now it's time for an analysis from one of our in-house analysts, Mr. Respect Kwenzi. Respect, good evening, and thank you for joining us on the Earnings Review.
It's always my pleasure, Ibn. Thank you for having me.
Beautiful. Let's start by talking about how the entity performed over the past year, how there was a decline in as far as the gross premiums there. And of course, Mr. Jawa did make an indication that in as far as the financials were concerned, that there was perhaps that effect of inflation wearing down or weighing in on the revenue generated from the employees in as far as employee funds are concerned.
Thank you. So I think looking at the Zimbabwe landscape, especially in 2019, there's been significant value erosion on incomes. And when you're looking at insurance, it's right at the bottom of the pyramid in terms of necessities of life. Of course, yes, it's a very necessity. When life becomes better, you want to ensure in the event that things might go either way, health-wise, life-wise, and so forth. But I think as your income shrinks, you also start to rearrange your needs. And this has been one of the biggest challenges, in that when value has been eroding in terms of incomes, people are pushing themselves towards basics of life, struggling with rentals, struggling with, all those kinds of basics. They push themselves down that chain. So for most of the insurers, definitely there has been a reduction in terms of their collections in real terms, but as well as even in nominal terms. We have actually seen a dip in the broader sector. So looking at Fidelity, the way they are arranged, much of their income comes from premium income, which simply means the collections, especially on the health side. So there has been that decline in line with the broader fundamentals prevalent, especially in the key market of Zimbabwe.
Fantastic. And now that you just mentioned how they are looking at other markets, can you just explain how important this development of their Malawian unit and how it ties into perhaps the medium-term trajectory for the entity?
Yeah, I think it has been particularly important, especially in the past year, when you saw Malawi's contribution actually increasing. I mean, even in 2018 as well, late into 2018, getting into the half year of the prior. I mean, there has been that gradual increase in contribution from this regional operation. But I think of significance there is the fact that looking at Zimbabwean companies from 2009 getting into dollarization, they have actually tried to scale down in terms of their regional operations, looking inside because of the hard currency. I mean, earnings in hard currency were actually more preferred than these volatile currencies. But now we are back into that scenario again, mono currency, very volatile, losing value against other currencies, and now so earnings from outside are actually bringing out even more value than the local investments, although the scale is quite low. So I think diversification is always a good thing, and especially in times where things are looking rosy in one market, I don't think that companies should sacrifice the long-term likely gains just for the purposes of maximizing short-term gains. I think this is the lesson for all the companies, from all the Zim companies, to say we always need to have a leg into some markets which might be lucrative and which might hedge whenever there is a crisis back home.
Now, there is now a development taking place in that very sector where there is a growing demand for cover in harder currencies. And of course, I think I was looking at the financials for Zimre, where they were alluding to the fact that they were engaging IPEC for them to be given the leeway to actually play on that very note. So how fast do you think IPEC is going to respond to such clamors from such sectoral players as Fidelity?
I think in every institution, especially from government agencies, there's always this bureaucratic red tape which always makes it so difficult to adjust whenever the need, whenever need arises. So that same situation is what we find ourselves in, especially on the IPEC matter. So there has been that call, but then the necessity in terms of the market, definitely there is a market for that. Actually, when government said you can now receive part of your incomes in USD, they're actually creating value, especially for USD backed premium. So I think it's a matter of time now, since that the economy is now operating with dual currencies. I think they're gonna now have to expedite it, other than at a period where they were guided by the monocurrency status.
Well, thank you so much for the respect, for the comprehensive analysis. Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and visit our informative website, www.equityaccess.net. Eben Mapunda from Harare, this is Equity Access.